Welcome to the channel where we help traders achieve their financial goals. Today, we'll be talking about the idea of turning $100 into $10,000, which is a common goal for many novice traders. But is it attainable? The answer is yes, but only through luck and taking substantial risks. That's why I want to provide you with some practical guidelines to help you grow your trading account in a smart and efficient way. So, stay tuned for the full video and don't forget to subscribe. Risk to reward ratio. The risk to reward ratio is one of the most crucial aspects of expanding your account in an efficient manner. It's the ratio between your target and stop loss. I advise a minimum ratio of 1.5 and a personal minimum of 2 to 1. Why? Because with a 1-to-1 ratio, you need to have a win rate of over 50% to be profitable. With a 1.5 to 1 ratio, you only need a win rate of over 40% to be profitable. This extra 10% makes a huge difference and reduces pressure on your mindset. Finding a middle ground for a small account, you need to find a middle ground with a good success rate and a moderate risk to reward ratio, ideally 2 to 1 or 3 to 1. You can also use a simple system for position sizing, such as risking 1 to 2% of the account size per trade. This approach is slow but safe. Conservative versus aggressive approach. I want to offer two alternatives for growing a small account, a more conservative and a more aggressive money management strategy. The Kelly criterion is a formula that determines the optimal risk per trade and is considered a more conservative strategy. It uses the win rate and loss rate to determine the optimal position size. On the other hand, the aggressive approach involves taking on higher risk and leveraging the potential for larger profits. This approach is best suited for traders who are comfortable with taking bigger risks in exchange for the possibility of greater rewards. Scalping as an alternative. Another alternative for growing a small trading account is the more aggressive approach, which involves taking more risks in order to achieve higher returns. One strategy that is often used in this approach is scalping, where traders take advantage of small price movements in a short period of time. However, scalping may not be suitable for all traders, as it requires a lot of discipline and the ability to stick to a set of rules. In conclusion, growing a small trading account requires a balance between taking calculated risks and protecting your capital. By carefully considering your options and finding a strategy that works for you, you can increase the chances of success and achieve your goal of growing your trading account. Don't forget to subscribe to the channel and stay tuned for more helpful trading tips and tricks.